All right, this time we're going to do exercise 17 11, and that is a change in the tax rates. And you'll see that we have in year one, we have three items that create temporary differences in our books, right? And then what happens is in year two, um, the tax rate has changed from 40% to 34%. So remember that we can only book these when the governing body in whatever country that we're dealing with, the governing body, or it could be a state, actually changes the statutory tax rate. So it's what's actually on the books at the time. And so the way we do that is we prepare a grid of some various things. And so we're going to have the installment sales first. And we see for GAAP purposes, it's 500,000, and for tax purposes, it's 100,000. So we want to recognize that difference, and that difference is 400,000. And because the GAAP basis or book basis is larger than the tax basis, that means we're going to have a deferred tax liability. And so we recognize the fact that difference, the book tax difference, tax is smaller by showing a negative. And then the next thing we do is we want to list the current deferred tax asset or deferred tax liability. And we signify the difference by putting a parentheses around it for deferred tax liability and showing it as a positive for a deferred tax asset. So we multiply the current tax rate of 40%, or the year one tax rate times 40%, and we get 160,000. And then we have to have the new DTA or DTL. And so now we're going to take that same 400,000 and multiply it by the new tax rate, which is 34%, and that comes out to be 136,000. And then we're going to show the difference. Now, because the amount of tax that we owe goes down, remember we haven't paid this yet, the amount we are going to have to pay goes down, we will show that as a positive. And that difference is 24,000. Okay. And so that'll be the increase or decrease there. All right. And so the next line is going to be the warranty liability. And so we have a $60,000 GAAP estimated warranty liability, but for tax purposes, we can only use the actual cost, and that turned out to be 40,000. And so the difference there is 20,000. And in this case, the amount of tax we pay will be greater than, and so that actually creates a deferred tax asset. So we multiply that times the old rate of 40% and gives us 8,000. And then we do that by the new rate, and so which is 34% times 20,000 gives us 6,800. Now, that means that we actually paid taxes in advance, and since they lowered it, we don't get some of that benefit anymore. And so that difference, The difference here is $1,200. And since we paid it in advance and we don't get any refund for the benefit, we recognize that as a negative. Then finally, we have the depreciation expense. And it is $80,000 for book purposes, GAAP purposes, and $120,000 for tax purposes. Now, this one's a little bit counterintuitive, right? The difference there is $40,000, but we're going to put it in parentheses because we're recognizing the larger expense, which means we'll be paying taxes later, right? In the first one where we had installment sales, we will recognize the revenue later, so we pay more tax later. And in this one, we recognize the expense earlier, so we end up paying more tax later. So we show that the same direction. And so our deferred tax liability is going to be $16,000, the 40%. And the new DTL will be $13,600. And that difference is $2,400. All right, so now we're ready to make our journal entry on that. And so the deferred tax liability, we add these two together. And that's going to be $26,400. Then we need to add this all up. 26,400 minus 1,200 will be 25,200, and that will be our income tax expense. Now, why are we making an expense a credit, right? Because remember, the tax rates went down. We recorded the expense before, but we didn't actually pay the tax. And so what's going on here now is I will end up paying less tax. So I'm having to decrease the expense I recorded last year, and I record that this year. And yes, we're a little bit mismatched out of time, but that's how we do this for financial reporting purposes, because it didn't happen until the legislature changed the tax rates. Now, obviously, I need to balance on this, and so that's going to be the deferred tax asset. And that will be the $1,200. And now I balance, and that concludes exercise 17-11.